Hi, it's me again. I just wanted to go through this standard chapter 11 standard cost explanation. We've got a special problem here called Darrington ice cream, but in the previous video we went over the material price variance, the labor variances, and the overhead variances. And now we're going to apply this in a specific problem, which in your text is on page 428 and 429, and it goes all the way into 431 before we get finished with it. So here, Darrington ice cream, the standard cost information is that they have a direct material of 800 gallons at $2.50, and we have actual cost information on it. We purchased 810 gallons at $2.72, and then we have a production of 809,000 gallons. Direct labor of 125,000 hours at $12 an hour. We used 130,000 hours at $12.10 an hour. Gallons in overhead, we have $1,000, a million gallons at 75 cents. And so that's an applied at standard of $750,000. The flexible budget overhead for overhead is $700,000, and to get that is a combination of $450 of fixed plus 25 cents for each one of those for times a million gallons to come up with this $700,000 of flexible budget overhead. The actual overhead is $680,000. Now what we're going to do is we're going to come up with the variances here first. So you can see we're going to start with the material price variance. We purchased at price of $2.72. The standard cost was $2.50, and you can see we got that from those over there. So that's an unfavorable variance of 22 cents per unit. And we have a volume of 810,000, which is what we purchased. So you multiplied 810,000 times the 22 cents, and we come up with an unfavorable variance of $178,200. Now, to get the material quantity variance, we take the 809,000, which is what was put in production, and we compare that with the standard of 800,000 hours. Gallons. So we come up with a difference of 9,000 gallons. We've gone over the standard. And the standard price is $2.50. So multiply by that $9,000 times $2.50 gives us an unfavorable material quantity variance of $22,500. Now let's talk about the labor. The labor's in the labor rate is $12.10. The standard labor rate's $12. So there's a rate variance of 10 cents. And we actually used 130,000 hours. So 10 times 130,000 hours is $13,000 of unfavorable labor rate variance. Now the labor efficiency variance takes the actual hours of 130,000, which we got from right over here, and we subtract that from the 125,000 standard hours. We come up with a variance of 5,000 hours. We've incurred 5,000 hours more, and you multiply that at the standard rate, and we come up with an unfavorable labor efficiency variance of $60,000. Now the controllable overhead variance. You can see that was $60,000 right there. And you compare that with $700,000, which is the flexible budget overhead, which we had right here. No, I'm sorry. We compare that with the overhead at standard. Now I'm screwed up a minute. I'm right here. 700,000 hours compared with 680,000. So we actually had 680,000 of actual overhead. We want to compare that with the flexible budget overhead, which is 70,000. So we've come up with a favorable variance of $20,000. The overhead volume variance takes this overhead, the flexible budget overhead, which is 700,000, and compares that with the overhead at standard, which is at $753,000. So we have a $50,000 favorable variance. Now, let's record. They want the book goes through recording these variances and these costs in a journal entry, which I think is quite instructive. It takes a little while to see it, but I think it works through and it's quite interesting. So we have we're going to debit raw material inventory, and we're going to do we purchased 810,000 gallons, but we're going to record it at standard cost. So we got $2.50 times the purchased amount, and we come up with a raw material inventory, a debit of $2,025,000. And we had 810,000, what we purchased, and we had $2.72 was the amount that we're going to pay, and that's what we recorded in accounts payable. And the difference between those two is that $178,000 unfavorable variance. Now the work in process, we're going to debit work in process. We're going to debit that for $800,000, which is the standard, the direct material at standard, multiplied by the standard labor or price rate. So we come up with $2 million, which is what we're going to record in the direct material inventory. And our raw material inventory that we're going to take out of that is $809,000 multiplied by $2.50, which is the standard cost coming out of there. And the difference is material is the quantity variance. So we're going to record it in work in process at standard. We're going to record the raw material inventory being credited at standard. And we have to do that because we recorded this inventory up here at standard cost, so we're taking it out at standard cost. And the difference between the two is that material quantity variance. I hope my tongue hasn't been tied too problematic for you. Labor costs. How do we record that? Well, we've got labor. We've got the work in process. It's going to be 125,000 labor hours at $12, which is the standard rate. So what we're going to put into work in process for labor is $1.5 million. Now we've got wages. We're going to pay 130,000 hours, which is what we incurred here at $12.10. So we're going to have accounts payable, wages and salaries payable of $1,573,000. So the difference between those two, the $1.5 million and the $1,573,000, is the labor rate variance of $13,000 and the labor efficiency variance of $60,000. Going down to manufacturing overhead, the actual was $680,000, which is right up here, and the various accounts that we're going to include and credit. Put it in there at various accounts is it totals $680,000. So now what goes into work in process is going to be the $1 million, which is this overhead right here, 1 million gallons. That's not $1 million, it's 1 million gallons times the standard rate of 75 cents. So we're going to put in there $750,000, which is this applied at standard. Then we're going to deduct that from the manufacturing overhead. So now we've debited manufacturing overhead here for $680,000. We've credited it for $750,000. So the difference between those two is comprised in this journal entry here, which is done separately. This is the way the text wants to do it. So we've got $70,000, which is the difference. So we're going to increase manufacturing overhead from $680,000 to $750,000 basically, and the difference between they're going to have a credits $50,000 for overhead volume variance and $20,000 for controllable overhead variance. Well, I hope I haven't butchered that too badly, but I think you can probably see what's going on here. What's interesting also is that all those variances are over here. 178,000 was that material price variance and so forth. All these total, these variances which we just went through over here right in here are over here, and they total $203,000. So at the end of this thing, the raw material is in here, and let me just show you where that comes from. A work in process, and for raw material, the work in process for direct labor. These are at cost figures here, and overhead is here, and they're all in there at standard. So that's $4,250,000. So we're going to take that $4 million. We're going to debit finished goods inventory for that amount, and we're going to transfer that from work in process inventory, which is this right here. Then we're going to transfer it out of work in process inventory to finished goods, and from finished goods we're going to go into the cost of goods sold and debit or credit. We're going to debit cost of goods sold and credit the finished goods inventory. Now we've got these variances here, and we have to write them off into operations. So we're going to take them, and we're going to take the ones that are this total cost of goods sold is 200. We're going to book them into cost of goods sold, and these others we're going to debit cost of goods sold for $203,700. We're going to debit the volume, overhead volume variance, and the controllable overhead variance of $20,000, and then we are going to credit the material price variance for $173,000, material quantity variance of $22,000, the labor rate variance for $13,000, and the labor efficiency rate for $60,000. And then we wipe out those variances. We book them all into the cost of goods sold. This is a pretty good exercise to go through. I think this is a pretty good problem. I hope I have explained it well enough that you can understand exactly how this thing works. So